In March of 2010, the Jamaica Deposit Insurance Corporation, JDIC, staged the first Caribbean Bank Insolvency Conference at the Rose Hall Resort and Spa in Montego Bay. Over 20 experts from countries across the Caribbean, Canada, the United States and United Kingdom spoke on issues relevant to the global financial crisis, international initiatives towards best practices and resolutions for bank insolvency. Today, you'll hear excerpts of the presentation given by the President and CEO of the Canada Deposit Insurance Corporation, Guy St-Pierre. Mr. Pierre spoke on the topic of Canada in a Financial Crisis, the Virtue of Boredom. We'll also feature that of the Senior Legal Counsel at the Bank of Jamaica, Robin Sykes. Mr. Sykes' address will look at from temporary management to vesting shares in the Minister of Finance, avoiding liquidation if possible. Robin Sykes is an attorney at law who has been with the Bank of Jamaica since 1997 as its senior legal counsel. His primary responsibility is the furnishing of legal advice to the Financial Institutions Supervisory Division.
I'm going to discuss some supervisory tools available in Jamaica, in the Jamaican framework, in relation to cases of bank distress and insolvency. I didn't want the topic of the presentation to speak as if liquidation was not an option. It's a good idea where little value remains and fundamental weaknesses are uncovered that cannot be cured, where you have a bank that is rotten to the core. It's certainly a good idea where it amounts to the least cost alternative to the state, and perhaps this is a lesson that we learn in retrospect. It may be a bad idea where there is strong interconnectedness with the financial system, and you can have contagion. It may also be a bad idea where there's no ability to make protected deposit or other resolution payouts in a clear and prompt manner, where these are crucial to preserve confidence in the system. It's also critical that the laws that you have, which underpin your system, are clear as to the supervisory powers. Jamaica experienced its own banking distress between the periods 1994 to 1998, and there were government interventions in 17 banking institutions and groups spanning a variety of financial services. Cost to taxpayers, $147 billion, or 42% of GDP in 2001. The intervention resulted in a reduction of deposit institutions from 70 to 17, and currently it stands at 14. The result of the crisis on a legislative front, it had wide-ranging amendments to our deposit-taking legislation, the creation of FinSAC, which was a resolution entity, the creation of the Financial Services Commission, which now regulates non-deposit-taking sector in Jamaica, as well as the creation of the JDIC. So the grounds now for temporary management are listed here, and two of the major ones are highlighted in bold. That is, the bank has contravened any cease and desist order or direction. So you can see the natural hierarchy of action that can take place once the supervisor issues a cease and desist or a statutory direction. There is no compliance, therefore graduated action towards temporary management. And then there is also in bold, the value of the bank's assets is substantially less than its liabilities. So these are fundamental issues that invoke this critical area of bank intervention. It's also important in taking temporary management or other intervention action that you consider the international ramifications. A regional crisis management plan is also being refined at the regional level under the auspices of the Caribbean Group of Banking Supervisors. So the constitutionality of temporary management was tested, and the courts found that since you are not taking away the property but really taking control of the institution, there was not a constitutional issue. So after temporary management, what happens next? Well, you have to now go to the court and decide on, do you go for liquidation, composition of creditors, vesting order, which is I'm going to speak on next, or the last one, restoration of owners. In the vast majority of temporary management cases, Government purchase, in some cases, government purchase for notional sums. Willing partners voluntarily injected capital, facilitated mergers, transfer of books of business and bad loans. In other cases, after the merger, licenses were surrendered and shells wound up. And the use of the vesting order was a critical element in these resolutions. The effect of the vesting order provisions where the powers of owners, managers, and officers are suspended. It vests the shares and subordinated debt in the Honorable Minister of Finance. And even though we have had amendments transferring some supervisory responsibilities to the central bank, such as temporary management, the power to vest shares remains with the Minister of Finance at this stage. We have significantly stronger banks and other deposit-taking institutions. We have a significantly stronger legal framework, including greater supervisory autonomy, more enforcement powers, rigorous capital requirements. We also have very stringent lending limitations. In Jamaica, a bank cannot issue an unsecured credit to a connected party, including its directors. So a director would not be able to get a credit card from his own institution. On our last assessment of our Basel core principles in 2006, our level of compliance, Jamaica was found to be compliant with 22 of these core principles. But the aftermath also includes our last point, which is critical, a significant debt burden, which has hampered national growth and led to government initiatives to lessen this burden, notably recently by the Jamaica Debt Exchange.
Guy St-Pierre is the president and CEO of the Canada Deposit Insurance Corporation, CDIC, and has been with the CDIC for over 22 years. He is an internationally renowned authority on deposit insurance.
As far as we're concerned, and as far as the international press, it would appear that we did do well. With the crisis, there was no bank failures. There was no government bailout. We did not inject any capital, no nationalization, no nothing. And also, even more important, there was no change in the coverage. Before the crisis, it was $100,000, and presently still $100,000. It is true that we did receive some help from the central bank for liquidity. They relaxed their standards with regard to what type of security they would take for liquidity loans during the crisis. The government also did introduce the debt guarantee programs, but they were so expensive, the fee was so expensive that nobody ever used them. So they were there for show more than anything else. Last but not the least also, Canada, since I believe 1994-95, had operated with a budget surplus. We don't like deficit in Canada. But unfortunately, because of the crisis, from 10 years of government budget surplus, we had to introduce stimulus, fiscal stimulus to help the economy. So our budget deficit last year was close to $55 billion. And again, this year predicted to be around 45. So yes, big help from the government to go through that downturn. And Canada did have GDP, negative GDP in the first 2 quarters of 2009. Not as bad as the other G7 country, but still substantial, 2.9%. First of all, I'll give credit, 20% to the credit to the supervisor. I say 20, you'll hear from me a little bit with the other 20. We had very strict standards of capital. While around the world it was 4 and 8, 4% tier 1, 8% total. In Canada, it's always been 7% tier 1 at least, and 10% total. In Canada, banks are not allowed to make a loan if the loan-to-value ratio is more than 80%. So that means that the property value has to be at least 20% more than the loan. Also, we don't have tax deductibility for mortgage interest. What it does mean, you'll say, well, that's not good. It is maybe not good, but what it means is that we don't have too much bubbling in the real estate market. the first thing Canadians try to do is to pay their mortgage. I would suggest sometime the first thing the American would do with a system where tax interest is deductible is to remortgage. And also, banks tend to keep their loan and manage their loan on their balance sheet because there is no securitization advantage with regard to capital if you securitize mortgages and loans. So I'll give credit to the policymaker, 20% of them. Another 20%, well, has to go to the bank themselves. As I say, my presentation, they're very, very, very boring. Sorry. They're quite boring. And they did not have too much exposure, like the United States, to structured products. There's no subprime market because of the reason I told you. In Canada, 80% loan to value. There's a little bit of few Alte market, but they're not really in the bank system, which the JDIC insure. It's more on the non-bank system. They have a very lucrative retail franchise. Also, our banks are quite big for Canada and probably for the Caribbean. But in an old scheme, when you compare the Citi, the JP Morgan, and some Japanese bank, European bank, they are quite small, with the largest bank with $600 billion Royal Bank. So conservative, large, but not big. So conservative management, good corporate governance, well managed, understand their risks. So we'll give them 20% to the bank. Now, where goes the other 20%? Well, come on, guys, JDIC. Well, how do we contribute to stability? Well, I could tell you, we do have a financial stability mandate. That means that we take that very seriously. We have a credible resolution system. It's been proven that throughout since 1967, JDIC creation. There's been 43 failures. And like my friend from FDIC said, nobody with insured deposit has ever lost money in Canada. That's how we stay active and contribute to stability. So there was no run, there was no crisis in Canada. They know we're very, very close to the United States. They look at TV, they saw the Lehman Brothers, they see all the banks failure, Washington, Wachovia, and so on. But I could tell you, maybe, well, we'll give credit to the JDIC. Things are stable with Canadians. They understand what's insured, what's not insured, and it's credible. Despite the fact that we did not have any failures, maybe we should again continue to increase the toolbox, improve the system. So what we did, well, we noticed that, hey, we don't have a bridge bank authority. So we introduced bridge bank authority. We look at our fund, our authority to borrow, and we thought, well, it's not enough. So we went and we increased that borrowing authority from $6 billion to $15 billion. Plus we have a fund, and I'll come back on that. And everything that we do resolution-wise has to be least cost because we have a mandate of minimizing exposure to loss. But what happens if it's a systemic issues, systemic bank? Well, we didn't have that power. So now we have a power to override the least cost, similar to the United States. And it has to be approved by cabinet, so it's not easily done. Also, we did not have the right to own shares, and it's an example in the bank. Well, we saw many resolutions for systemic bank around the world whereby there was investment in shares of bank. We did not have that power, so now we do have that power. We have increased our visibility. We have doubled our budget of public awareness. We're investing millions of dollars to revamp our premium payout system.
In our next episode, we'll bring you highlights of the presentations by the Regional Counsel for Dallas at the Federal Deposit Insurance Corporation in the USA, Donald McKinley, and CEO of the Malaysia Deposit Insurance Corporation, Jean-Pierre Savarin.